Good morning, everybody, and welcome to today's webinar, Life to the Max, hosted by myself, Brian Leising of Financial Brokerage. Today's webinar is going to be a little bit different. We don't have a PowerPoint. Instead, we're looking at an interactive sales tool from AIG, one of our 25 life insurance companies. Now, for those of you who may not be familiar with Financial Brokerage, we are a national marketing organization working with independent advisors and agents all around the country in the areas of fixed life insurance, annuities, LTC, disability insurance, critical illness, and now Medicare supplements. I'm one of our life insurance marketers here, been here about 15 years or so after some time selling primarily life insurance out in the field, much like many of you are doing currently. And this webinar is part of our month of June focus on the tax advantages of cash buildup and distributions from permanent life insurance policies. We've had a focus primarily on index life, and that's what we'll talk about a bit this morning, but also we don't want to forget about whole life, because whole life certainly has the same advantages tax-wise as an index life policy. Now, this morning, I wanted to bring to your attention something a little bit different. This is an interactive sales tool from AIG, one of our leading life insurance carriers here. You can get to this without a password. In fact, I got to it by a Google search of Life to the Max AIG, and eventually I found the right one. But this is meant to be an interactive sales tool for use with consumers. So this is something you can take with you. You don't have to take it with you. You can just bring it up on your computer. If your client is visiting your office, if you're in their home and you have internet access, maybe they can bring it up on a big screen TV. You can even bring it up on an iPad. I was doing that myself the other night to review the materials. And you can go through the whole thing. You can go over parts of it. You can pick and choose what you'd like to review with your clients. But it's all meant to help tell the story of using a permanent life insurance policy as an alternative source of funds, primarily for retirement, and why that might be a good idea. So I'm going to walk you through this as you might walk a client through the same thing. I should also note that all your lines are muted. You can still ask questions by typing near the bottom of the control panel, and I'll go ahead and get to those at the end. Now, there's a lot of wording on the various screens that you're going to see. If you are at a loss for words or want to find some additional information to tell your client beyond what they can actually read right in front of them, when you're looking at this with the client, if you see this little CC button in the lower left and you click on it, you're going to go ahead and see the scripting that AIG has put together for the entire presentation. I wouldn't recommend reading that to the client unless they really can't see something anyway, because, hey, why? I mean, they can read it themselves, right? So at any rate, it's there to help you out if you need it. So I'm going to walk you through the different sections here. We're going to start with this home page. We're going to go through the facts. We're going to go through the IUL solution. I'm going to skip over the Max Accumulator. That's their top accumulation and distribution product. We're not going to go through the details of that specific product. And then getting started, I'm going to skip that as well. But starting off here, you want to sort of set the stage for your client and tell them something along the lines of well, I'll just read off the script that AIG provided. Deciding you need life insurance is an important step toward helping protect your family with financial security if you were to die. But let's wait for just a minute to imagine what happens if you don't die between now and retirement. There are a lot of forms of life insurance in the marketplace, and you're going to be introduced to a program that can help provide supplemental tax-free retirement income in addition to life insurance protection for your family. Now, we know that retirement is primarily about replacing a portion of the income you receive from work with income from other sources. Typically, those sources can be divided into two kinds, and we know the first is direct income, such as Social Security benefits or pension plans. Now, there are usually no assets to manage with these forms of income. The monthly payments just show up automatically, and sometimes these sources are adjusted for inflation over time. Now, the second source of retirement income comes from assets, such as 401ks, IRAs, investment accounts, even real estate. And the source of income usually requires continuous management on the part of the retiree. Now, on every one of these pages, you're going to be able to see at the bottom here this closer look tab. And that's where you can expand upon the information on the page right there if you want to. So here's what I was just talking about the sources of income during a person's retirement years. Right? You may want to skip this part for some clients, or this may be a very important part of the presentation with them. Now, as we continue to talk to the client about managing their retirement income, you want to talk to them a little bit about the decline of pension plans and the rise of 401ks and IRAs over the last 4 decades. And bring home the fact that successfully managing assets has now become a primary responsibility of retirees and not necessarily the company that they used to work for. With company pensions disappearing, retirees have to become their own money managers or hire somebody to do that to ensure that their retirement income beyond their Social Security benefits is actually sufficient to meet their needs. All right, now we can get into the next section, the facts. So once we've established that retirees have to become their own money managers, there are really 3 facts that have become crystal clear over the last few years. Fact number 1, we know Americans are just not saving enough. I remember a statistic I saw several weeks ago that the average balance of a 401k plan is something like $75,000. It's just ridiculous. You can't live on that for very long at all. Fact number 2, and we've seen that over the last couple of weeks here, market volatility can put retirement income at risk. And we're going to go into more detail on that here. And fact 3, the future of income tax rates is uncertain and critical. You need to plan for taxes now and in the future, and life insurance gives clients options that they might not have otherwise. So let's take a look at each one of these a little bit closer. And to move on, if you're with your client, you can hit next. You can also go right up here to the individual facts. So if you want to go into the fact that people aren't saving enough, here's a page or several pages really that help explain that to the client. And AIG is drawing from a study done by Boston College, their Center of Retirement Research. And they found that over half of all Americans are not saving enough to maintain their pre-retirement standard of living if they retire at age 65. Now, this study did take into account Social Security benefits, pension plans, and home equity into its calculations. So when it's all said and done, how much should you really be saving? Well, this same study found that roughly 15% of your earnings should be saved, or about 1/6 of every paycheck. This number is a little less for low-income households and a little more for high-income households. Ask your clients, are they contributing 15% of their income to savings? I bet you most are not. All right, so now that we know that we should be saving 15%, we want to show them an opportunity that can help them save more while still protecting their family along the way. So no, people aren't saving enough. We also know that market volatility can put retirement income at risk. Now, generally, if you want to experience growth in your retirement assets, you have to face some level of market volatility. It's just par for the course. Typically, the greater the growth opportunity, the greater the volatility. And for many people, this involves investing a portion of their retirement savings into the equity markets or the stock markets. But while equity markets have historically offered long-term growth opportunities, it's the short term that can make big differences in a person's retirement success. And sometimes success or failure just comes down to unfortunate timing. Let's take a look at a couple examples here that really bring this home for the clients. Let's turn back the clock to 1985. Ronald Reagan's president. The average price of a new home is $90,000. Ticket to the movies is $275. PCs, personal computers, are just starting to show up in homes and offices. And Microsoft introduced Windows version 1.0. Can you believe it? Let's say our client is, at this point in time, 15 years away from retirement, and they have $100,000 invested in stocks tracked by the S&P 500. What's going to happen? Well, 15 years later, your $100,000 would have grown to $850,000. That's 8.5 times your original investment. This works out to over a 15% annualized rate of return. That's pretty good. I wish I could get 15%. Now, looking at the chart, the upward curve of the index might give people a false sense of security. They might feel that the stock market is always going to be a place for double-digit returns. People thought that about interest rates at the bank in the at some point in the 80s too, and we know what happened there. So that's one scenario, and that scenario looks pretty good. Let's imagine instead, though, that we have a client that is going to retire 9 years later. It's 1994. Bill Clinton's in the White House. The average new house is now nearly $120,000. The cost of the movies is $4 per ticket. That's still a pretty good price in today's numbers. Personal computers are everywhere now. We now have the first .com website registered. Now, you're the same hypothetical person, and you have the same $100,000 invested. But your financial world is about to change big time. What's coming up? We've got September 11th. We've got the bursting of the internet bubble. A few years later, as you're getting ready to enter retirement, the Great Recession hits. Now, what does that look like? It looks like this. There's a lot of ups, a lot of downs. Now, looking at this chart, we see that continuously upward curve from the 1985 view is gone. I mean, it's still there, but look what happens afterwards. This 1994 view has some pretty deep canyons and a big cliff at the year that we want to retire. So what happens now? Well, that hypothetical $100,000 has only grown to $145,000. That's less than 50% more than what the client started with, or a 2.5% rate of return. That's like putting your money in the bank, only the bank is going to return even lower interest rate today. Okay, so to finish off this hypothetical story, your retirement income is going to be about a sixth of what it would have been had you started just 9 years earlier. And the client didn't do anything wrong. All they had was bad luck and bad timing. They retired in the exact wrong year, but you have no idea what the market's going to look like when you retire. Are you going to end up with that 15% rate of return or that 2.5%? You don't know what's going to be going on with the markets or the world in any given year. So knowing that we don't know what's going to happen, what are the next 15 years going to hold? What impact are the markets going to have on a client's retirement nest egg? We can't predict the future, but we can learn from the past. And today, you're going to have an opportunity to walk your clients through an accumulation product that is designed to help reap the benefits of an up market while limiting their exposure to the market's downside, and all at the same time providing protection for the family's needs. Now let's take a look at fact number 3 that affects retirement income. The future of income tax rates is really uncertain, and it is critical. It has a big effect upon a person's retirement income. Most individuals save for retirement using one or more of several traditional tax-advantaged retirement accounts like 401ks, 403bs, individual IRAs. Now, why are these so popular? Well, primarily, most people expect that they will be in a lower tax bracket than they are pre-retirement. And their contributions to 401ks and IRAs are made with these pre-tax dollars that defer the taxation on the contributions and earnings until they retire. But what if they're in a higher tax bracket in retirement? Should you maybe be contributing to other forms of assets? So the traditional thinking has a person saying that, yeah, I'm making X amount of dollars now. I'm not going to need that much money to live on in retirement. My house will be paid off. I won't have kids in the home to pay for. I won't have to make extra money to set aside towards my retirement plan because I'll be living off of that retirement plan. Well, so therefore they'll be taking less income. They'll be in a lower tax bracket, right? Well, what happens if tax rates go up? Even if you're taking in less money, you might still be paying the same or more in taxes than you were before. And let's face it, we know what really happens when people retire. Well, what's the first thing they do? they start traveling. They go all over the place. They see all the places around the country and around the world that they never had time to during their working years. Well, guess what? That costs a lot of money. You got to pay for gas, you got to pay for airfare, pay for the hotels, pay for meals, eating out all the time. Right? People travel their first few years of retirement. Now, okay, once they get to the point where they've done all the traveling, they stop. But why do they stop traveling? Well, their health has changed, so they're no longer able to travel. Now they have all these medical expenses because of that. And so even though we like to think that our income needs will decrease in the retirement years, they might not decrease at all. They might increase, or they might not. At the very best, they're not going to decrease as much as people like to think they are, for all the reasons I just explained. So you pile that on top of the fact that we're going to look at some examples here that may point to higher income taxes in the future. You want to put yourself in a position where you can choose if your income coming to you is taxable or not, and you don't want to have to take the hit of potential higher taxes in the future. Okay, and I may have just clicked on this wrong thing. Oh, maybe I didn't. Nice thing about this is you're walking through with a client. If you click on the wrong thing, you can always go back. All right, so we know that the income tax rates you face now and during retirement affect three attributes of your retirement assets: your contributions, the growth within the asset, and the distributions or withdrawals. And these are really the three phases. If you caught the webinar a couple weeks ago, the IUL napkin sale, these are the three phases that your retirement money will go through: the contribution phase, the accumulation phase, and ultimately the distribution phase. Now, for any asset you can imagine, whether it's an IRA, a piece of real estate, or an investment account, taxes are due on at least one of these phases. Now, a traditional IRA, we know, generally uses pre-tax dollars for contributions, and the growth is tax deferred, but then the withdrawals are taxed when the client takes them. A Roth IRA would be reversed. You're going to pay taxes on the contributions, but the growth and the distributions are tax-free. Now, the least tax-efficient assets will tax you on two of these, and that would involve something like a savings account or maybe a CD at the bank, where you're taxed on the contributions and then you're taxed on the growth every year, but the withdrawals are not taxed. Okay, we know in a typical taxable account, the contributions are made with after-tax dollars, and the growth is taxed as it's credited or realized. And as I mentioned before, most mutual funds, CDs, savings accounts are included in this category. As you can see here, this would be what we call the taxed now category. Since growth is taxed right away as soon as it's earned or realized. Now, there are savings plans that generally offer some tax advantages on two or out of these three attributes. And these we're going to group into two kinds: the taxed later and the taxed never. So the first kind is the one where those contributions on the growth are tax deferred until it's withdrawn, typically at retirement. That includes the 401k plans and the IRA accounts. Now, the other tax advantage accounts, we're going to call those taxed never accounts. These are made with after-tax dollars, just like your savings account, but unlike the savings account, the growth is never taxed, even when it's withdrawn for retirement. So the accounts that fit this category would include Roth accounts, whether it's an IRA or a 401k, and cash value life insurance, which, if set up properly, can also act as a taxed never asset. Now, we know that most individuals have saved money in the taxed later types of accounts, such as the 401k plans and IRAs. It might make sense to take advantage of savings programs that are taxed never in order to reduce a person's potential exposure to higher income tax rates in retirement. And so this is referred to as tax diversification. And the product solution that you're going to see next can produce a taxed never income option. Let's take a look here next. Hopefully this will take us to the right place. We're going to look at some possible clues about future taxation. And I did not hit the right button, so we're going to go back. We're going to go back again. Here we go. This is one of those closer look sort of one of the aside tracks that you can take a client down if you need to. Now, we've said before that nobody can predict the future, but let's take a look at some indicators of potential future tax rates. A really interesting place to start is with the history of the highest and the lowest federal income tax brackets. And looking at this chart, I mean, you ask anybody on the street, they're going to say, oh yeah, income taxes are too high. Well, really? They've been higher in the past. Most people don't know this. Now, looking at the chart, you can see that since the inception of the current income tax system in 1913, we're actually in a period of modest tax brackets over on the right. And one might even predict that tax brackets off of this chart will likely go up in the future. So it's also important to note, and we'll get into this too, that in 2009, the federal budget experienced the biggest deficit in history at nearly $1.6 trillion. Now, since that was the largest in history, we know it's been going down since then, but every deficit adds to the national debt, which continues to get larger and larger. Something else you can do here with your clients too, any one of these red targets up here, you can click on it to see what was going on in history at that time that likely led to a change in the highest marginal income tax bracket here. Here we can see in 1941, okay, America entered World War II. What happened here? We entered World War I. Afterwards, taxes went down. Okay, height of the Roaring 20s. Everybody was making money, right? Then the Great Depression starts, and you know what? Government needs some more money now. Oops, and I went too far here. Anyway, you can click on any one of those to give your client a little more insight into what was going on. All right, so we know here that since income taxes are used to pay for the federal budget, here's a closer look at our most recent year. This is the 2015 federal budget, and we can see that Congress and the President approved a budget of $3.7 trillion in expenses, but we only had $3.26 trillion in revenue, about half of which comes from individual income taxes. So this gives us a $440 billion deficit, and that's money that we have to borrow, which is added to the national debt. So that brought the national debt to over $18 trillion. Now, we know that Congress is having difficulty addressing this situation, and most situations really. And for the 2016 budget, they approved similar expenses as 2015. But here's the other thing they did. They voted to reduce the amount of revenue. Now, wait a minute, that doesn't make any sense, does it? They approved the same budget, which was too much for the revenue coming in, and then they said we're going to approve even less revenue. So it doesn't make any sense. It's not going to fix the problem. So at some point in time, a reckoning is going to come, and the country is going to need more money coming from income taxes. How are they going to do that? Well, they're probably going to have to raise the tax rate somewhere along the way. So do you think your taxes are going to be higher or lower in the future? You can also take a client through what this would look like if it was a household budget. All they did is cut some zeros off and round the numbers, and to really have the client see how this would work on a maybe a more personal level to them. Okay, now if anybody had any thoughts about the national debt being a short-term condition, this chart will show the progression of the debt since 2000, the year we had the largest surplus in history. That's when we didn't have a budget deficit for that fiscal year. We actually had a surplus. And then, a president changed and we were attacked, and so much for the surplus. And then the deficits started appearing again and going up and adding to that national debt. So looking at this chart, I mean, the national debt, do you think it's a short-term or a long-term condition? It's just getting worse and worse and worse. So again, do you think your taxes will be higher or lower in the future? Now, AIG has another chart in here, if I can find it. Maybe it's this one right here, the best type of plan. This is, this is an interactive system, so I would invite you to turn the mouse over, or the iPad over to your client if you're walking them through this, and you can have them figure out which might be the best type of plan for their situation. So what this chart does is it imagines a contribution of $10,000 per year of pre-tax money for 20 years going into a plan. And it can be a taxed now plan, a taxed later plan, or a taxed never asset. And in every one of these cases, the account's growing at 6%. So we have some constants there. The only thing that will be different will be the tax rate that the client pays at various phases. So during retirement, the client's going to withdraw the same $25,000 per year of after-tax funds, and we're going to see how long that money would last under different tax scenarios. So whichever one really lasts the longest is the best case scenario for your client. So the default setting here is what people used to think about retirement, is that they're better off taking a deduction now and paying the taxes later in their retirement years, because they think their taxes are going to be lower in retirement than they are today. So with this scenario, the client's retirement money is going to last 21 years. Well, what if they have this same type of account, their IRA, their 401k, and tax rates are actually the same? They're not in a lower tax bracket. Oh, now we lose a few years off of our retirement plan. And what if, as we've just shown, taxes go up because we've got to pay for that national debt at some point in time? Now we're down to 16 years. We've lost some time off of that retirement income stream. Maybe people don't cut off years. Maybe they reduce the income that they're receiving. So if tax rates are higher, that 401k, that IRA, isn't going to look so good. It's not going to be such a great decision. Now, we don't want to even mess with the tax now plans. That would be savings accounts and CDs, and we don't deal with that at all. But what if our client had a taxed never asset, such as a Roth account or a life insurance policy? Well, if their tax rates are actually lower in retirement, which good luck with that, okay, our money is only going to last 16 years, so we should have had it in the traditional 401k. But if our taxes are the same in retirement and we have our money in a Roth or a life policy, look, now we get back to 18 years. If tax rates are higher, as we think they likely will be, now we're back to 21 years. So what's really going to happen? We don't know. I think this is the likely scenario here. Your client doesn't have to move all their money into something like this, but they should seriously consider moving part of it. That way they can choose which account to take their money from based upon what taxes actually are during their retirement years. So let's talk about the solution that we want to lead them to here next, and that's the IUL solution. And if you've caught some of the other webinars this month and back in June too, we've gone through some of this information in a different format here. But some clients haven't heard of Index Universal Life. They don't know what it is. It's been around nearly 20 years. But still, as far as insurance products go, it's fairly new. So we've already established that most of us aren't saving enough, and market volatility can leave a big impact on retirement savings. And we really don't know what the future of tax rates is going to be. They may very well be higher. I think they're likely to be higher than they are today. Well, because of all that, you should really get to know a little bit more about Index Universal Life and how you can use that as an alternative when considering a life insurance purchase or your retirement plan. And this can really help you address these facts in a new way. So one, we know that IUL can help provide additional retirement accumulation, helping you potentially increase your retirement savings while providing survivor benefits to your family. Fact number two, IUL can offer some protection against market volatility with the way it credits cash values and can provide a potential upside with downside protection. Now, there's no risk of loss in an IUL. And fact three, we know that IUL or any permanent life really, if set up properly, can offer the client a taxed never asset to assist with tax diversification. And the tax-deferred accumulation and tax-free income can make this taxed never asset a great addition to a person's other retirement assets. So let's take a little closer look here. What is Index Universal Life? Well, it offers permanent life insurance protection with a cash value component that isn't as rigid as the original cash value life insurance, otherwise known as whole life. And it's not as volatile as its most recent cousin, Variable Universal Life. It comes with a whole host of options that make this product really a very distant relative of your grandfather's life insurance. Now, that's because an IUL policy offers the potential to be credited with interest based on the upward movement of the stock market index, but it also helps protect against the downside when the market stumbles or falls. Now, over the next few screens, you can help your client learn about what an IUL can do for them, but it's important to note, too, that IUL is indeed life insurance. It's not an investment. Owners of IULs are not investing in an index. In fact, consumers can't invest in an index, but each year after expenses and charges are removed from the account inside of an IUL policy, the excess cash value has the potential to realize growth through index interest credits. Now, you can click on the video with your client. I won't do it here because you won't hear the sound, but you can have your client watch about a 2-minute animated video that walks through sort of the history of life insurance and how an IUL works. You can also walk them through these 3 points at the bottom here, the closer look, and we'll take a quick look at those right here too. You can take your client, if you need to, through the evolution of life insurance. I mean, most people know what term insurance is, and maybe they've heard of whole life, but they haven't caught up with even the 1980s, and they don't know anything beyond that. So if that's one of your clients, they've been living under a rock for 40 years, you might want to walk them through this. We know that term life is extremely popular. It's cheap initially, but it's temporary, and it's really not likely to pay out. I mean, the statistics are less than 2% of all term policies pay out a death benefit. Clients don't keep it that long. They convert it to something permanent. In a lot of cases, it's a big waste of money. I mean, you have to have it, but for most people, they're never going to see a benefit from it. So in reaction to that, because of that, person might want to look at a whole life policy. This is where you can buy and not rent your coverage. It's got an internal cash value that builds on a tax-deferred basis and gives your client some guarantees. So the death benefit's guaranteed to never change. Cash values are guaranteed. The premium is guaranteed to stay level. The downside to something like this is it costs a lot more than a term policy, and people don't always realize all the benefits, and that's why they probably buy term in many cases. All right, after whole life, because I think in part of the cost, consumers didn't necessarily like that. Buy term, invest the difference became a popular motto of a lot of folks, and the industry responded by unbundling that whole life contract. So now clients can take advantage of current interest rates that are usually higher than the guaranteed floor, which would probably be equivalent to what they were seeing in the whole life contract. And your policy is in force as long as your account has money. This costs a lot less than a whole life, but has less guarantees. Now, further on in the evolution of UL, the insurance industry came out with the GUL, or the no lapse guarantee UL, where the policy doesn't have any cash value, more than likely, but your client has a guaranteed premium that will never change. Death benefit will never change. It functions a lot more like a term for life contract, and that has become extremely popular. They don't go into that in the client presentation here. But a few years after UL came out, insurance industry came out with VUL, variable life. So rather than use a conservative interest rate, now the cash values can vary with the ups and downs of the underlying stock and bond accounts. This gives your clients unlimited upside and unlimited downside potential with their contract. So you can participate in the big gains, but your money is going to be at risk. So what came next? Well, some people didn't like having their money at risk. In the late 90s, we saw the advent of index universal life. This is really the industry response to a consumer desire for a better than fixed interest rate return, but without the downside risk of a variable universal life. And the accounts in an IUL cannot lose value in down markets. So how does an IUL do that? How does it protect against volatility? Well, this is a really interesting example, I think, of comparing how an IUL works to how a bank works with your savings account that you might have there. So we know, or most people know, if you put money in a savings account at a bank, the value of the account can't shrink unless you pull money out of there, right? The bank isn't going to charge you negative interest. They're going to give you interest on the account. It's not much, but it's something. So every month or every year, they're going to credit your account with a certain interest amount. Well, how does the bank get that interest? well, they're loaning money out at a higher rate, but they're also investing some of the bank's money in money market instruments, which could grow or even shrink, and the bank assumes the risk there. And more often than not, they are receiving positive interest, which they can then pass on to the client, but the client's savings account is protected. So how is that like an IUL and an insurance company? All we have to do is replace some of the players here in the scenario, and we'll see that the client's index interest account is protected. The value can never shrink, much like in a savings account. The insurance company is going to be crediting that account every year with the interest rate, which is based on a formula. Now, the insurance company is using the insurance company's money and investing in equity market instruments. In this case, they're putting money into options, and they're also putting money into those same money market fixed interest accounts. So this is one way to help explain how the client's money is actually not at risk of loss, because their money is never in the market. It's the insurance company's money that assumes any potential risk, and really hardly any of that. Okay, another way to look at this would be to see an IUL in action. And so here's some examples of actual stock market returns from '94 through 2009. And if your money was actually in the market, you've seen some tremendously high years here, some returns over 30%, but also some pretty terrible years. A couple with greater than 20% negative returns, a 47% negative return. And this is that person who had $100,000 and retired at the wrong time and only got a 2.5% rate of return over that period of time on their money. All right, so this is the money actually in the market itself. Well, what if we had that money in an index account, and this one is using a participation rate, and it's 60%. So whatever the market does, your client's going to get 60% of that number. And if it goes negative, they're just going to get a zero. They're not going to participate in the downside. So if all we do is participate in 60% of the upside, none of the downside, guess what? Instead of a 2.5 rate of return, we have a 7.2 rate of return in that same time period. Looks pretty good. Now, the more popular indexing method is actually using a cap rate. And we'll see that here in this next example. With a cap rate, let's say in this case 12%, you're going to get whatever the market does positively up to 12%. After that, you're not going to get any more. You're never going to participate in the downside, though. So given the same scenario, if you had a 12% cap, at the end of that time period, you're going to see a 6.7% rate of return on your money. Still pretty good. Which one is better? Well, who knows? In any given time period, the participation rate or the cap rate might look a little better than the other. All right, if you need to review again the features of a taxed never asset, and actually some of the extra features that weren't covered earlier, this page can help you do that for the client. You can reiterate the life policy offers tax-deferred growth, tax-free distributions. You won't want to forget about the death benefit, because this is a life insurance product we're talking about here. That death benefit, which is always greater than the cash value, will pass 100% tax-free to the client's heirs. You don't have to worry about taking money prior to age 59.5. There are no penalties like you have on qualified retirement plans for doing that, and you don't have to start taking money after age 70.5. Don't have to worry about required minimum distributions. It's up to the client when they want to take the money and how much. The loans come off of the cash value, and or the withdrawals. You can withdraw the money that you've put in there as well. The rules of the road, this probably isn't so much for the client, so much as for you when you're designing one of the illustrations on these. We know policy has to stay in force, and we don't want the policy to be a mech or to have too much money in there, or it won't have the all the tax advantages. So that's as much as I'm going to go over this morning on the Life to the Max. Once I get a listing of everybody who was on this webinar, I'll go ahead and email out a link to this Life to the Max presentation. Again, you can use all of it or parts of it with your clients. You don't have to use the same thing. If you need the script, which I stayed pretty close to, all I have to do is click on the closed captioning button down the lower left there, and you can walk your client through the same thing. So bear with me just a second here, and I'm going to hit stop recording.